Today's mindful moment.
Ever wonder what a high-stakes poker game has in common with trading billions of dollars? Maybe more than you think.
Definitely. Today we're looking at Salomon Brothers in the 80s, a place where those lines got seriously blurred.
Right, through the lens of Michael Lewis's Liar's Poker, it paints this incredible picture, doesn't it? A real pressure cooker.
It absolutely does. Such a vivid, often pretty funny insider's view. We're digging into the people, the games they played literally and financially, and the huge shifts happening back then.
It really captures what some called the peculiar macho culture of investment banking. I mean, Salomon Brothers compared to Animal House.
Yeah, it sounds wild, but Lewis makes a compelling case. You really get a sense of that raw, competitive drive.
And that dynamic between John Gutfreund, Business Week's king of Wall Street,
Right.
and John Merriweather, who the trader saw as the real king of the game, Liar's Poker.
That says so much, doesn't it? It
Yeah.
points to a real cultural split within the firm itself. It wasn't just about who had the corner office.
No, it was about perceived power. Gutfreund felt trading was direct win or lose, control the loot, gain admiration, maybe fear.
Whereas managing,
Managing, he thought, brought envy and fear for, well, the wrong reasons. Managers didn't directly risk the firm's capital in the same way.
which really gets to the heart of that trading floor mentality. It was about taking risks, making quick calls under pressure.
And that's where Liar's Poker fit in, apparently. Merriweather and his crew didn't just see it as a game.
No, they genuinely seemed to believe it tested character, honed the instincts needed for bond trading. It was almost a training tool for them.
It sounds like an obsession. These guys with PhDs in physics and math.
Totally consumed by this high-stakes bluffing game.
Yeah.
It's a fascinating mix of analytics and, well, gut feel.
So when Gutfreund challenged Merriweather to that $1 million hand,
Yeah.
it feels like Gutfreund trying to say, hey, I'm still a player, on their terms.
Exactly. A symbolic gesture, trying to bridge that gap or maybe reassert dominance in their world. It shows how central the game was to that specific group's identity.
Speaking of the people, Merriweather's team was unusual for the time, right? Mostly young guys, 25 to 32.
Yeah, and loaded with PhDs, math, economics, physics. Not your typical pinstripe suits fresh out of business school.
And yet, they dove headfirst into this liar's poker culture.
It's that blend, again, high intellect meets raw competition. They weren't just academics observing, they were right in the thick of it.
Even Lewis's own entry into Salomon was pretty unconventional. Failing interviews told he lacked commercial instincts.
That classic kiss-off, yeah.
And then getting an offer through a hint he nearly missed. It sounds almost accidental.
It really does. And his point about economics becoming this abstract filter is sharp. Banks wanted practical people, but economics served as a kind of academic hurdle.
A ritual sacrifice, he called it. Not about genuine interest anymore.
Right, which makes his earlier idea, the we stop the plop dog satchel business.
Hilarious, but also kind of telling, right? That fear of missing the Wall Street Express bus.
Totally relatable, that pressure to get on the accepted track, even if you have other ideas.
And contrasting that with the rule in interviews, don't mention the money.
Yeah, that's bizarre. Talk about challenges, deals, smart people.
Anything but the main draw for so many people. It's quite the contradiction.
It speaks volumes about the image the industry wanted to project versus the underlying reality.
Okay, so Salomon in the early 80s, they were huge, most profitable investment bank in the world.
Pretty much. Their fortress was the bond market. They knew how to value bonds, trade them, sell them, better than anyone.
Except junk bonds, right? That was Drexel Burnham's turf.
That was Milken's kingdom, yes.
Yeah.
But everywhere else in bonds, Salomon reigned. They understood risk and yield in ways others just didn't yet.
It's strange how bonds didn't capture the public imagination like stocks did. Lewis notes how few books or memoirs there were about bond people.
Almost like a hidden world. And that obscurity, that lack of widespread understanding, actually benefited Salomon.
How so?
Well, they talked about profiting from man's ignorance. In a market where not everyone understood the true value of complex bonds.
The ones who did understand, Salomon, had a massive edge.
Precisely. A bond's value was effectively set by whoever could value it properly, and that was them. They were the experts in an opaque market.
So that expertise was their gold mine.
Absolutely.
Then there was the training program. Sounds less like training, more like hazing.
Maybe a bit of both. Lewis describes it as brutal. The anecdote about the trainee in the tweed suit worrying about buying 6 new suits.
Yeah, on a boiling hot day. It perfectly captures the clash between ordinary life and this high-pressure finance bubble.
Right, and the myth of the savage Salomon trader wasn't entirely true, maybe, but the training itself. He likened it to being beaten up by the neighborhood bully. Odds of getting in were supposedly 60 to 1.
And once in, trainees were treated like commodities, slaves.
That's the term Lewis uses. Managers debated their merits, swapped them. Intense pressure. You absolutely needed a sponsor, a powerful managing director backing you.
Which led to that Ponzi scheme of personal popularity.
Yeah, trying to look desirable so the big bosses would want you. It was all about perception and connections, not just raw ability at that stage.
And the Japanese trainees, sleeping in the front row.
Bizarre, right? But they became heroes to the back row somehow. It also reflected Japan's rising financial clout and Salomon wanting a piece of that action.
The back row sounded like a force of nature itself, loud, unified.
Setting the tone, yeah. Rewarding speakers they liked with the wave, like a stadium crowd.
But the kicker was, once you hit the trading floor, all that training hierarchy vanished.
Totally. Tenure meant nothing. A newbie could become a big swinging dick overnight by making millions. Pure meritocracy in a very raw sense.
It was all about the bottom line, instantly.
That rapid potential for advancement, purely on performance, must have been a huge motivator.
This seems like a good point to mention. For listeners interested in digging deeper into insights from influential books like this, check out Mindful Moments and our podcasts. It's an AI audiobook analysis YouTube channel that explores these kinds of key takeaways.
Good suggestion. Because there are subtle lessons here, too, beyond the obvious aggression.
Like O'Grady learning from Penn King, the senior salesman who subtly manipulated a difficult trader.
Right. It wasn't about shouting louder. It was about understanding the social game, navigating personalities to get things done. Those skills were vital, too.
Then you had the opposite end of the spectrum, the human piranha.
Yes. Aggressive, profane, but knew the bond market inside out. Apparently, even seasoned traders were nervous around him.
His warning, if you fucking buy this bond in a fucking trade, you're fucking fucked, is pretty unforgettable. And probably effective.
It shows respect came in different forms. Raw knowledge and intimidation worked too.
Now, the mortgage department, that sounds like its own bizarre ecosystem within Salomon.
It really does. A place where new hires apparently faced abuse from senior traders.
Who thought it led to enlightenment? Seriously.
That's the rationale Lewis describes. A strange, probably quite toxic initiation. But somehow, that department was incredibly profitable.
They controlled a huge chunk of the bond market, right?
Yeah.
Some of the firm's highest earners.
Yeah, they were a powerhouse. Which makes the prank on Matty Oliva even stranger. Gutfreund involved in a fake SEC investigation over stolen cheeseburgers.
It's just nuts. But it shows their unique, insular culture and maybe a very dark sense of humor.
Definitely unconventional. It highlights how separate they felt from the rest of the firm.
And their skit mocking the Texas thrifts, the salesman versus the clueless thrift managers in polyester.
It's played for laughs, but it underlines this obvious point. The thrifts often didn't understand what they were buying or selling, and Salomon's sales tactics were aggressive.
Enter Louis Ranieri, the guy who basically invented the mortgage-backed security market, right?
He was the visionary there, saw the potential, figured out how to package and sell mortgages as bonds, and his hiring was unusual too, pulling people from the back office.
He valued loyalty and drive over fancy degrees, it seems.
Which created this unique culture clash within Salomon.
Yeah.
You had the government bond guys, Hermes ties, doing triathlons.
And then the mortgage guys, like an Italian family, more focused on eating well than Ivy League credentials.
And the rest of the firm just kind of tolerated them, wondering, what do those fucking yo brains over there do for a living? Despite their huge profits.
Amazing lack of understanding internally.
And the thrifts, the 363 Club guys, Lewis paints them as tragically naive.
Didn't understand the market, kept coming back for more even after getting roughed up financially.
It really highlights the danger of that information asymmetry. The sophisticated players versus the unsophisticated ones.
Okay, let's shift to junk bonds. Michael Milken and Drexel Burnham turned finance upside down with those.
Absolutely revolutionary. Focusing on high-yield, high-risk bonds. For companies, the rating agencies shunned. It gave smaller, growing companies access to capital.
And Milken had this sort of populist message for investors, too, challenging the old guard.
He fundamentally changed corporate finance, offering potentially higher returns, but of course, higher risk.
But Salomon, the bond kings, were late to this party. Why?
Well, Ranieri specifically seemed wary. Lewis suggests he feared losing his grip on the savings and loan clients if Salomon got into junk bonds. He even publicly called them dangerous.
So protecting his existing turf possibly blinded him to the new opportunity.
It looks that way, a classic innovator's dilemma, perhaps. Fear of disrupting a successful model.
And that hesitation cost them, right? Because junk bonds fueled the M&A boom.
Massively. Milken provided the firepower for takeovers. Firms like First Boston, with Wasserstein and Perella doing the deals, cleaned up.
While Salomon, stuck in its bond trading focus and with senior management not really getting junk bonds.
They largely missed that whole M&A bonanza. Their own intense, successful culture might have created blind spots.
Then things got personal for Salomon's management. Ronald Perelman tried to buy a big chunk of the company.
Yeah, a direct threat to Gutfreund's control. That must have been a shock.
Leading to Gutfreund calling Warren Buffett for help.
And Buffett got that famous sweet deal, lending money, getting preferred stock, rather than just buying common shares like everyone else.
Which basically meant Salomon shareholders paid a premium to keep management in place.
Exactly. It raised serious questions about whose interests were really being served.
And Gutfreund dismissing Perelman as just a name. Wow, given Perelman's track record as a raider.
Seems incredibly dismissive. Maybe arrogance, maybe denial, but definitely out of touch with the new realities.
Then, bam, Black Monday, October 1987, the stock market tanks.
A huge sudden crash. But the bond market.
The bond traders were cheering.
Right, because money fled stocks and poured into safer government bonds, the classic flight to safety. Bond prices soared, and Salomon's bond desk made a killing.
One market's disaster is another's windfall. Crazy.
Even gold behaved weirdly, falling when you might expect it to rise. Theories involved margin calls, forcing sales, maybe deflation fears.
Complex market dynamics in a panic, and Salomon itself started buying back its own stock.
Gutfreund encouraged it, and employees piled in too, presumably seeing it as cheap. A mix of corporate strategy and self-interest.
After the crash, the finger-pointing started, blaming the British government for proceeding with the BP share sale.
Always easier to find an external scapegoat than look at systemic issues, isn't it?
And that Salomon managing director rehearsing his threat to the Bank of England, threatening another crash if they didn't help Salomon avoid losses on BP stock.
That's high-stakes poker right there.
Yeah.
Shows the pressure and the lengths they'd consider going to.
It all culminates in people leaving. Lewis gets a big bonus, but realizes it's panic money.
Yeah, Salomon was bleeding talents and trying to stop the outflow. His decision to leave wasn't about the firm collapsing, more just feeling like he was done there.
He'd learned what he needed, experienced that world.
And his father's reaction to his salary. That's powerful. Shaking a lifelong belief that high pay equals high societal contribution.
Makes you really think about value, doesn't it? Especially in finance.
Absolutely. What are we actually rewarding?
Alexander encouraging his unconventional departure is a nice touch, too. Sometimes the non-standard path is right.
True. And the final irony. Southland, one of those junk bond-funded deals, eventually did okay while Revco went bankrupt. Shows the risks were very real.
High yield meant high risk, no guarantees.
And Salomon taking that big loss on the BP underwriting because they honored their commitment.
It shows, despite everything, there was still some sense of obligation, maybe, even when it hurt financially.
It suggests a complex picture, not purely mercenary, perhaps.
So wrapping this up, what stands out from this wild ride through Salomon in the 80s?
For me, it's the sheer ambition, the appetite for risk, and that incredibly intense, unique culture, where a game like Liar's Poker felt like essential training for finance.
Yeah, the lines blurred completely. Fortunes made and lost so fast. It really pushes you to think about instinct, information, maybe even luck in making money.
And how much of that was driven by genuine understanding versus just riding a wave. The way they dealt with the thrifts, for example, exploiting that knowledge gap, feels like a lesson that's still relevant. Critical thinking is key.
Definitely. Which leaves us with a final thought. Were those big swinging dicks brilliant innovators reshaping finance? Or were they just gamblers who got lucky in a roaring bull market?
And how much of that high-octane, sometimes ruthless environment still exists on Wall Street today, maybe just in different forms?
Something to chew on. If this look into Salomon Brothers grabbed you, do subscribe to our channel for more analyses like this.
And please share with anyone who enjoys stories about ambition, risk, and the often crazy world of finance.
You can find links to grab a copy of Liar's Poker in the description if you want to read the full account. Most importantly, keep thinking critically about the forces shaping our financial world.